You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everyone, and welcome to the Infinite Banking Mastery Podcast. Thank you for being here. I appreciate you. So today I wanted to talk about, should I own whole life on my children? Well, yeah, I think so. Of course. What a great idea. I think that's great. I think having whole life on your children is one of the best things, as of course, time is one of your greatest assets. It's your greatest asset when you're talking about investing in anything, really, or saving into any savings plan, because the amount of years you have for your money to be compounding, that's really where the power is. And so having those extra years, having a small child have something start so young for them, it becomes quite amazing in their older years, should they retain the policy and keep it as they should. So what a gift for your children to be able to set them up this way and start a policy for them when they're very young. People sometimes ask me, well, what age should I start my child? Should I do it, at a certain age? And I say the sooner the better. So born after 15 days with a social security number, and we're good to go. So really, it's up to you, your budget, what makes sense for your family. But I do think it is a great idea. So what kinds of things could the policy be used for? So that's another thing, because once you start this policy and you have these funds building inside, they could be used for anything. Maybe you want to designate those policies or that policy for your child for their needs specifically. Maybe they will need braces or something in their teenage years, or maybe you'd want to use it for their first car. Make it a little easier. You have this money already set up, saving up for them. Of course, college is definitely on a lot of people's minds, and that's a great place to have money building for your children, is inside of a whole life policy. Maybe their wedding or first home. And of course, they can keep this going, borrow these funds out for things that are needed. Either you can borrow them out and be replenishing them yourself, or your child can be borrowing them out and replenishing those funds themselves. And then if they retain the policy, then awesome, they'll have it for retirement, and they'll have a whole bunch of funds in there that didn't feel that painful to save up for because of all that time that they had helping them along with all that compounding interest, because they didn't have to save as much. The older you are, the more you have to save to reach the same goal as someone who is younger. So that's just a win for them. And then once your child reaches an age that you feel they will be trustworthy enough to take care of their policy and do the right thing and pay it back and not let it lapse, or whenever, you can do it whenever, but a lot of people want to make sure their kids are going to do the right thing and be doing the best they can and keep the policy going. But whenever you want, really, you can turn this policy over, the ownership, to the child. And then now the child will have the policy and be able to continue funding it, or you could continue funding it, or you can even borrow funds out and then pay them back. And you can keep the policy a whole lot longer if you like to. You don't have to give it at a certain age. You can give it at whatever age you want. And if you choose never to give the policy to the child or sign it over to them, for them to be the owner, then eventually, when you do pass away, they will automatically become the owner of that policy. So there's a lot of things that you could do when you're thinking about when you want to, the timing of when you want to give over the policy to the child, or if you do, or what age you do. There's a lot of options. So back to what I mentioned earlier about being able to use the policy for college funding. I know some people, maybe that's a great idea, or they've never heard of it before, or some of you have heard of, I know it was on TV for a while in commercials, the Gerber plan, save some money for your kid. Costs can start as low as $3 or $4 a month, and you'll have this whole life policy building for your child, and you can use it for college or, for their future. So $3 and $4 a month is really not going to build you up really anything, I would say, for college funding. And there will be funds there, of course. It's just really not enough and enough time to really get it to build up. So I'm not sure why they promote that with such a low premium dollars. I think that's unrealistic to really have very much to help them with in college, maybe buy their books for a year or two. And that cost too for being so low. And that's what they say, like the starting price is. That means that the child's probably incredibly young or just born. So it just depends. It's possible to get a very, very low costing policy for the child. But if you want it to really be something that you're going to use for things that they're going to need in as they're growing up, their first car or college or whatever it is, wedding, you're probably going to want to fund it higher. But again, that really can be customized to your needs and your budget. And it's something that we would talk about and make sure that it's a good fit for you. Of course, at the end of the day, some coverage is always better than no coverage, or some amount of whole life is always better than none. So I would say, again, it's just up to your budget and making sure it all makes sense and it's fitting for you. Just that you're going to want to fund it a little bit more for actually achieving something helpful for those college years. And then once they get to college, those college years, they would then be able to borrow against the policy, or if you're still the owner of it, you would be able to borrow against the policy for those tuition costs. Sometimes those costs, you might want to even let them build up a little bit more. Maybe let them take some loans out and feel what it's like to be becoming an adult. And maybe there's some other ways that you want to help fund college as well. Maybe you let the funds sit for a few years until the end of their college career. And then you have maybe some loans have built up or whatever, and you just go into your policy and take out the funds and pay off those loans. And so that's another way that you can use them, maybe let them grow a little bit more, pay it off a little bit later. But it's just an option that you'd be able to use that money or some of that money to help your child through college. So speaking of borrowing against your policy for that purpose, I also had checked out the Gerber plans again that I was just mentioning, and the loan rate on that I just looked up is 8%. So they have an 8% loan rate for you to be able to borrow those funds for whatever needs you could possibly have. And so I thought that was kind of high, actually, because my primary company right now is only charging 4% for those loans. And that is 4% guaranteed for your life. And so there's some different options there with how the interest, you're paying your interest, or if you want it to be variable or fixed, but you are guaranteed to be able to access a loan at 4% right now with current contracts. Now, insurance companies do every so often make changes or update these rates but they're pretty slow to do those things. And so it's not like all of a sudden we're raising these rates tomorrow. It takes a while. It's more like the tortoise. It just moves really slow. But eventually, those rates are likely to change. But once you have your contract rate, that's fixed for your lifetime. That's your guaranteed rate. So yes, my favorite way would be to borrow against my policy for my kids, for their college or whatever their secondary learning might be after high school. Another very popular savings vehicle for that would be 529 plans. I'm sure a lot of you have heard of those plans. Now, I am fully licensed to help people with these types of accounts. However, there is very much compliance in the securities industry. So I stay away from that topic at all costs in my podcast because I do not want the compliance department to be upset. So I don't want to speak on that topic, but I will just tell you, I'm just going to give you a couple of stories though about them. I have a good friend who is an advisor who a while back had 529 plan for his child. And he was setting that money aside, doing really well, saving well into it. It was a very decent sized amount of cash. And so now she's ready to go to college. She's ready to start tapping into this account. And then boom, hello, 2008 market crash. And so the account dropped significantly and he lost pretty much all the funds to send his child to college. And so that was very devastating for them. They had it all planned out. They could see it. They're like, we're good. We have the money. And then in an instant, that money was wiped away. So there's that story. And then there's also a story where I had one of these accounts myself. And being an advisor, I had charged myself, basically no fee. I had this money with a great money manager that I had selected. The account was designed to shift in strategy as we neared the college years. And so at the time, that I had this account and then all this was happening in the market, I thought, I'm going to switch gears and I'm going to save into whole life instead. I'm not going to be directing my funds into this plan. Instead, I'm going to change to a whole life plan for my kids. Since I already have money in here, I'm just going to leave some of it here. I'm going to leave a little bit just so that I can see what happens. Maybe it will grow really well. Maybe it'll be awesome. And I'll have this extra cash in this account for when they're ready to start school. And not very long later, maybe a year or 2 years, well, the money was gone. So there was no money. So the account wiped itself out, even though I was charging myself no advisor fee. So that's 2 of my stories about that type of plan and why I am not doing that for my own children. So basically, based on my own experience, my friend's experience, being in the industry almost 20 years, I just prefer whole life for my family. I like the stability. I like that it's guaranteed to grow. I love all those things. And so I know as well that many of you have looked into or wondering about, or maybe have a GET plan, a guaranteed tuition plan. They're maybe slightly differently named in different states. But for me, again, I looked into it when my kids were young and decided it wasn't a good direction for my family to go. After looking into some of the programs that were failing, I thought, I don't think I want to entrust the government with any more of my money. It's not like they're doing a super great job as it is. So as an example of how states have been struggling with this guaranteed education program, Alabama has had a real heck of a time, and they almost collapsed about 10 years ago. In the early 2000s, I'm sure right around 2008, with all the stock market losses, and then with all the really high increases in tuition, the program was left short and they had to be bailed out in 2010 with a $548 million package. And that still wasn't enough. And they just had their last infusion of $177 million from that original package of 548. So I remember reading back then, because right back then was right around the time I was researching this for my own family. And I remember reading back then that they were having this problem and they weren't able to fund it. They were going to need this bailout. And what they were going to do was they're about to tell everybody, hey, sorry, we can't afford college like we said we would. You were supposed to be able to buy these tuition at your current rate at the current year that you're buying those tuition credits, and then have your child attend college in the future at no additional cost because the tuition would have already been paid. Sorry, we're not going to be able to provide that. Tuition's just skyrocketed and the market hasn't done well. So what our plan is just to refund you the money you paid into the GET program or the guaranteed tuition program. Except for we're going to have to deduct out about $3,000, because we've held your money for, 10 to 18 years, however many years we've held your money, and we've had to hold on to it and take care of it. So we're going to have to deduct $3,000 for admin fees, but we're going to just basically return your money. So as expected, parents were outraged because they wanted the cost of tuition, which was way more than the money they had put into that program. And so then that's where the bailout came in. So it's just been a program that has had hardships being successful. And even Texas, they also had a struggle. I was just looking up and reading about that. And in 2014, they were saying we're going to be insolvent in 5 years. And the plan's estimated unfunded liability at that time, or in 2013, was $612.5 million. So these plans have a hard time keeping up with the cost of inflation on college tuition, especially with the volatility in the market that we all experience. So it's hard for them to keep that promise of that high cost. So in fact, the Alabama plan is scheduled to be closed in 2032. It's just been too risky. They can't maintain it. So they're excited. They're going to be able to finish it off up till year 2032, and then they're going to end the program. So due to those kinds of things going on, it's just too risky for me. No, thank you. I'll stick with my whole life. I like whole life. Each of my kids have 2 permanent policies. I love using whole life policies for them to be able to save into and have those building up for them for college or whatever they may need. And then I can also have them paying back into their own system for their first car or for college or whatever we use the funds for. And the good news is that if they don't go to college, they still have these funds there for whatever other purpose they could use them. They might need them for, or could find to use them for. For example, maybe they want to start a business. Maybe they want to start a business soon after high school. Then they'll have the funds already built there to be able to help them with their idea and their talent. I bought my first business when I was 21 years old, and then I built a new location for that business and relocated it when I was 22 years old. And so, yeah, it would have been helpful to have some funds laying around for me to be able to do that with. And so I think that having those whole life policies are great for multiple use, for college, for if they don't go to college, they can use them for something else. And since I'm the owner, I can choose when I'm handing over that policy to them, or if I'm going to keep ownership of it or use the funds myself and pay them back slowly, or turn it over to them and continue paying back on some loan that I took out for something that I was using. There's just so much you can do with it, and you have so much more options. Then there's no restriction as with another type of college savings plan. I do think it's important that as you are building these plans for your kids, or maybe using them for the things that they need as they age, that you should teach them, help them to understand how to use this policy. If you've built this for them, help them, have them read Becoming Your Own Banker, have them learn the process so that they are on board with continuing this and continuing to make the policy better and to build their own banking system better and stronger and to be highly successful with it, especially with having that boost of having you as a parent start it for them when they were young and have that extra power behind it of the extra time, fueling them forward to have. You might be saying to yourself, well, I don't know that I can afford that. Maybe I'm not able to do a whole life policy for my child right now, or I just want to focus on me or my spouse because we are the breadwinners of the house. We're making the money. We need to focus there first, which is definitely important. Another idea would be to put a term insurance rider on one of your policies that would supply about $25,000 in death benefit for up to 6 children. The cost is about $12 a month. And so that would cover 6 children. And then you would be able to have the opportunity for that child then at age 25 to convert that term rider into their own permanent whole life contract for up to $125,000 of coverage and with no underwriting. And so they could start their own savings plan based off of that small rider that you built into your own plan and just had them covered during that time so that they're covered, which is important because you never know what tragedy can happen. Yes, that there's always that. But then to look at the bright side, you would have the opportunity for your child to acquire their own savings plan with no underwriting. Children do become uninsurable. I have lots of stories of people whose children have become uninsurable before they reached adulthood. And so locking in coverage for them as well is a good idea. And then they can start their own plan or, expand on it from there. And so some people might be asking too, like, why do you have 2 policies for each of your children? Well, really the reason is because the first policy I started for them, my income was lower and I couldn't put as much as I really wanted to into a contract for them. So I did as much as I could, knowing that time is the greatest asset and having those years, those extra years for the snowball to compound that interest and grow really big. So I started them as young as I could with what I had. And then as they got a little older, I wanted to save more for them and start another plan. So then I started a second plan for them. So it's not really about how many plans can I have. It's more about what is your maximum insurability. Life insurance companies do have a maximum amount that you're able to be insured for, and that's based off of your income and your age. And so the amount of policies doesn't really matter, how many I can have or whatever. It's more about how much do you earn, how many more years do you have to retire, to retirement age, and then what's your maximum insurability. So that's really all I have for you today. Thank you again so much for listening. If you would like to reach out to learn how a policy, an infinite banking style whole life policy could work for you and your family and your budget, I would love to connect and learn more about you and find if there's a way that we could make this work for you. If this is something you're interested in, please reach out to Valerie at alphaomegawealth.com. I would love to connect with you. Have a great week.
This is thepodcastfactory.com.